Welcome to this episode on entrepreneurship development. In this episode, we will continue with our discussions on the financial appraisal or a financial analysis of a project. In fact, if you go back to one of our previous episodes, we had introduced the topic of financial appraisal, and we had looked into issues like the internal rate of return and the net present value concept, based on which we find out the feasibility of the project itself. But then there is more to the financial analysis than just the internal rate of return or the net present value. For example, the financial analysis of a project would look into a number of other projected cost estimates. What are these? Number one, it looks at the projected capital cost estimates. It also looks into the projected operating cost estimates. And the third item it looks into is the projected revenue estimates. Information collected for this purpose, they are put into the form of a pro forma balance sheet, a pro forma operating statement, and a pro forma cash flow statement, from which you can understand the financial feasibility of the whole project. Now, see, it is mainly concerned with the development of the financial profile of the project, and it deals not only with the financial aspects of the project, but also with the operational aspects. This is what we have not discussed till now. We had discussed with the feasibility aspect of it, but then we have to look at the operational aspect also. Now, what is done is, the investment strategy is evaluated in terms of the investment criteria, like we had discussed the last time, the internal rate of return and the net present value. But how do we complete the other aspects of the financial profile? Like, how do we understand the operational cost estimates? For that, we have to look into various costs which are going to be incurred as by way of operation of the project. But before we go into that, let's look at the projected capital cost estimates. That's the first thing we'll look into. Now, what do you think projected capital cost estimates would include? What about the preparation of the entire project sheet, the project report? That itself is going to consume some expenditure. Maybe you will have to appoint consultants to carry out techno-economic survey, or maybe you'll have to carry out the possibility of finding the right kind of raw materials, survey of the raw materials market, and so on. So and in fact, the whole cost of project formulation, as we had discussed in one of our previous episodes, project formulation is a very important activity, and you have to generate reports. To generate reports, you have to do some information collection, and maybe you'll have to hire consultants or experts to do all that. So the total advance expenditure, all that expenditure which you will incur even before the land has been acquired, that expenditure will also go into the cost of, or rather the capital cost estimate. What else? Plant and machinery costs will be involved. For example, the cost of, let's say if you are going to import plant and machinery, it will include that cost. It's not only a question of plant and machinery which is imported, but also cost of the indigenous plant and machinery that is going to be installed in the plant. They will also have spares, so cost of those spares will be included. Again, freight and insurance charges will be involved. There will be local taxes and duties which will be levied on those equipment. Not to forget the installation expenditure. When you import plant and machinery, or you install domestic or indigenously produced plant and machinery, one common item would be the erection charges, the installation charges, and all other overhead expenses connected with the total plant and machinery being put in place. That's one item of capital cost estimate. What else? Can you think of any? Land, for example. You have to acquire land. So the cost of land will find its place in the statement of capital cost estimates. The cost of acquiring the land, and also the cost of developing the site so that the plant can come up on that site. That's another total cost of land. Anything else you can think of? We have talked about land, we have talked about plant and machinery. We have to talk about the cost of buildings and civil works also. Okay. Once we acquire the land, and where are you going to put the plant and machinery? They have to be put inside plants. So you have to erect buildings, construct buildings. So the cost of buildings and all other allied civil works will be there in the projected capital cost estimate. Like the cost of the project, shed maybe. If you're going to set up a factory shed, the cost of that shed or the cost of the premises will come under that. The cost of it, if there are any administrative or office buildings which will come up, the cost of that is going to be mentioned here. There could even be other ancillary buildings. Like there could be godowns where you'll stock your finished goods or you stock your raw materials. So the cost of ancillary buildings will also become a part of the cost of buildings. You may also have to erect, residential buildings and other civic amenities for the employees who will work in that plant. Cost of building those residential houses and other things like hospitals and schools and other amenities, which will come up, those will also be included here. And all other services which are required to be given if there is a township coming up. So the total building cost will also become a feature of the statement of capital cost estimates. And there are many more. I'll mention a few of those to you. Like there could be even, cost of, there are intangible expenses which are going to be incurred. Like you may have to pay for, patents or licenses or copyrights. Where will these go? Or technical know-how which you're going to purchase from the market. Consultancy fees for engineering services. For example, to set up a plant building or to set up the process plant, you need to hire engineering consultancy services. Now you have to pay them fees for that. These fees will come under the intangible expenses. There could be a provision for escalation. Now all these estimates, they are all projected estimates, remember. So you will always be uncertain as to what is going to be the exact amount that's going to be spent on any of these heads. So you have to provide for escalation for each of these items of expenditure. Like you'll provide for escalation on account of land cost, you'll provide for escalation on account of plant and machinery, escalation on account of building cost, escalation on account of other ancillary assets. So you have to have a provision for escalation in the projected capital cost estimates. And you have to provide for unforeseen items at a certain percentage of the actual cost which you can foresee as of now. So these are really provisions for contingencies which may be required because there's a lot of uncertainty involved here. All this will add up to what is called the total capital cost estimate for the project. Now this is one very important item that is required for a complete financial analysis. So you can all have a look at the statement of capital cost estimates. This is one very important input. Okay, now let's move on. The second item of projected cost estimate, as I said before, is the project operating cost estimates. All these are capital cost estimates, what we have discussed now. Now, that is just to set up the plant. But once the plant is up and is running, then to operate that plant, you have to incur a lot of expenditure. Now, what are these expenditures? Like, for example, the cost of raw materials, okay, or the labor costs. These are absolutely variable costs, okay. The more we produce, the more will be the raw material consumption, and hence the cost of raw materials will go up. The cost of labor, to a very large extent, is variable, okay. So it is a variable cost that should find its way in the operating cost estimates. Then there are energy costs involved. You'll utilize energy for most of the kind of operations that we see today. A lot of energy is consumed. So energy costs have, and they are very expensive. So energy cost is a very important item in the operating cost estimate. The plant maintenance cost is also an element of cost in the operating cost estimates because you have to keep the plant in good condition, in proper shape. Everything should be functioning, nothing should be down so as to give you the desired output. So the plant maintenance cost will also be an element of the operating cost estimate. There again, to carry out all this, you'll have to engage supervisors, and the cost of supervision is also a cost that will be included in the operating cost estimates. The supervisors are there, and over the supervisors there will be administrative and managerial people who will kind of overall oversee the operations and manage the operations and control the operations. So there is an administrative and management head where costs will be incurred. So these costs will also be a part of the operating cost estimates. Another item that needs to be mentioned is the depreciation charges and interest on borrowings. These are also a part of the operating cost. You know what depreciation is. We charge a certain amount of depreciation, plant and machinery as it gets used over time. We charge a certain amount of cost and call that depreciation. So that over a span of time, over a span of the life of the equipment, the equipment can be replaced by a new one. So depreciation charges and other interests on borrowings which have happened will also find their way into the projected operating costs. So these are, in summary, I would say that we have looked at two aspects of projected cost estimates. One is the capital cost estimates, which are to be incurred even before the plant starts producing anything commercially. It has not yet become operational. And a second head of cost where all the cost estimates which you make are going to be incurred in order to run the plant, operate the plant. So these are two broad heads under which we have to be able to forecast the costs over a span of time, and they play a very important role in taking a financial appraisal of the project. So we take a short break at this point of time and we come back and discuss about other aspects. Okay, fine, thank you. Welcome back. Before going into the break, we had spoken about two heads of cost, which is a part of financial analysis. One is the projected capital cost estimates, and the second one was the projected operating cost estimates. Okay. Now, one point which we need to mention here is that all the projected capital cost estimates are to be incurred before the project actually gets off the ground. Okay. But as far as the operating cost estimates are concerned, they will be incurred repeatedly over different periods of time. So you need to be able to project the operating cost estimates over time. Unlike the the cost estimates meant for the capital cost, which is only a one-time expenditure, the operating cost estimates will be recurring in nature. So you will have to be able to somehow forecast it over the first year, second year, third year from operation, and so on. And to be honest, if you could project it over the entire lifespan of the project, that's the best thing that can happen. Now, having said this, we move into the third item, which is important, the operating revenue estimates. You will have to be able to balance the operating cost estimates with the revenue estimates. Okay. So the revenue forecasting will depend for its accuracy on the correct assessment of the project demand potential. That's very important. The forecasting becomes a very important exercise, and the anticipated sale price of the goods or services which you are going to produce. Okay. So a lot depends on how much you are able to forecast the potential demand for the goods and services and the price at which you will be able to sell to that market and to meet that potential. So a lot of market research, or at least an extensive market study, is required for you to be able to project with any degree of conviction what are going to be the operating revenue expenses. Once you do this, then what is going to happen is you will look at a pro forma profit and loss statement. Now, what is a profit and loss statement? We all have, I think, some basic understanding of what is a profit and loss statement. See, the matching of the operating revenue and the operating costs of a project over a period of time will result in the operating profits or losses for the enterprise, right? So it is one of the basic documents needed for developing the financial profile of the project. You agree with this? Yes. Okay. So if you try and create a pro forma profit and loss statement, let's say from this year to the next year, then what would it look like? And this also, remember, you'll have to be able to forecast for the first year, the second year, third year, and so on. Now, I'll just ask you, if you remember something about the profit and loss statement, what are some of the items that are there on the profit and loss statement?
Means the part of the revenue which is earned by the from the project.
Right. The first item on a profit and loss statement is always the gross revenues. What is the sales revenues? How much would you sell, and what is the gross revenue that you are going to earn as a result of your business activities, right? And from that we deduct the returns and allowances. When you sell, some of the items may not be good, so you'll have to accept the returns which are not good and make allowances for those prices which have been paid may have to be returned. And you'll also subtract the discounts which you would offer from the list prices of the goods that you are going to produce and sell. So from the gross revenues, you deduct the returns and the allowances, you deduct the discounts which you would allow, and that will take you to the net revenues. Okay. Now you have got the net revenues. The other aspect is the cost of goods, okay, sold, cost of goods or services that you're going to sell. Now within the cost of goods sold, items are like the raw materials cost, the operating labor cost, the energy cost, the supervision cost, repair and maintenance cost, royalty and know-how cost, depreciation, very important item, and all other incidental expenditure. So this is going to add up to give you the total cost of goods sold. Okay. So we have got three items now. The different costs coming under the cost of goods sold I have mentioned, they all add up and give you the total cost of goods sold. So from the gross revenue, we come to the net revenue. From the net revenue, we deduct the total cost of goods sold. And what are we left with? We arrive at what is called the gross margin. Okay, the gross margin. I'll repeat. From the net revenues, we deduct the total cost of goods sold, and what we get is the gross margin. Now, from the gross margin, you deduct the total selling and general expenses. What you get then as a result of that deduction is the operating profit before interest and tax, something which we call earnings before interest and tax, EBIT. Okay. From the operating profits before interest and tax, you will deduct the interest charges, and you will get what is called profit before tax, PBT, profit before tax. From the profit before tax, you will deduct the income tax, okay, and you will get what is called the net profit or the profit after tax, PAT. Okay. From the profit after tax, you will deduct the dividends that you are going to pay. Okay. And this is going to leave you with something called the retained earnings. Right? This is what is interesting to the company. Having met all its obligations, what is the retained earnings for the enterprise? So there are different formats by which you can prepare the pro forma profit and loss statement, but by and large the contents will be these. Okay. Now, once you are able to forecast or estimate reasonably accurately what are going to be the gross revenues, net revenues, cost of goods sold, the selling expense, the gross margin, the selling expenses, the administrative expenses, the operating profits, and the profit before tax and after tax and all that, year by year, then you are basically tracking the financial progress of the enterprise over time. Okay. Now, this is what we would like to, an entrepreneur would like to foresee to the extent possible, even before he takes a decision to invest in that project. So we are basically trying to project all costs into the future, not only the capital cost, but also the operating cost and how the operating revenues are and the operating costs will play out, so that you are left with certain retained earnings, and are they acceptable to the entrepreneur who is going to take that decision to invest in that project or not to do so. Okay. So this is the role which is going to be played by the pro forma profit and loss statement, trying to balance between the operating cost estimates and the operating revenue estimates. Okay. Thereafter, we'll look at the pro forma balance sheet. Okay. Now, the pro forma balance sheet is prepared on the basis of the projected inflows and outflows of resources. The validity and the authenticity of the balance sheet will, to a large extent, depend on the validity and accuracy of the pro forma operating cost estimates, the operating revenue estimates, and the pro forma profit and loss statement. So once you have done all this, maybe you could take it to the stage of the balance sheet, the pro forma balance sheet. And here again, we try to do it, comparatively year after year, because every year you're going to prepare a balance sheet, and what would that balance sheet look like after the first year, after the second year, after the third year, and so on? If we are able to forecast, then this is what is going to give the entrepreneur or the investor a very clear idea of what the business would look like, let's say 5 years or 10 years down the line. Okay. Basically, a balance sheet is a balance between the assets and the liabilities, right? So assets and liabilities is what the entrepreneur is going to look at, and how are they balanced in the company. Okay, fine. Let's first start with the assets. Okay. What are
assets? The buildings, land, machinery.
So there is a component of fixed assets and there is a component of current assets. Okay. Now, what will come under fixed assets?
Machinery, plant, building,
land,
goodwill.
buildings, plant and machinery, furniture and fittings. Okay. Goodwill is an intangible asset and it's not normally shown on the balance sheet. Okay. So remember that primarily land, buildings, plant and machinery, furniture and fittings, and from that you deduct the depreciation for the fixed assets, okay, to get total net fixed assets. Okay. So that is the fixed assets part of it. What about the current assets? What are the items of current assets?
Debtors, cash, bank
Okay.
balances.
Cash, bank balances, all marketable securities that are held by the company, the sundry debtors, people who owe you money, okay, sundry debtors, inventories that are carried by the company by way of its operation. Within inventory, we have raw materials, we have got work in progress, we have got finished goods. So all those add up to inventories. Any prepaid expenses made by the company before it was due is also a part of current assets. Okay. So I repeat, we talk about cash, bank, marketable securities, sundry debtors, inventories, all prepaid expenses. They all are added up to get the total current assets. Okay, so we have the total fixed assets, the total current assets that makes up the asset side of the balance sheet. Now, if you look at the liability side, what are the liabilities? Again, we have got current liabilities, something called current liabilities. What are liabilities? Something that we are liable to pay out. Is it not so?
Yeah.
Now, so what do you think will be the items that will feature as current liabilities? By current liabilities, we mean liabilities which will have to be met over a shorter period of time. Okay.
Creditors.
Sundry creditors. You buy several things, okay, small items on a day-to-day basis maybe, and you owe these people money, and they extend you some kind of a credit period, and that amount which is held, by you, which you owe to the people who have supplied your goods or services, are sundry creditors. What more? Taxes payable. You have to pay certain taxes to the government for carrying out your business
Bills which are
activities.
the bills payable.
Bills payable, sundry creditors, taxes payable, any outstanding expenses,
It's the outstanding liability
right?
portion.
Correct. Whatever you are supposed to pay which you have not paid, all outstanding expenses, proposed dividends which you planned or declared to pay to your shareholders. Okay, proposed dividends. So all this will sum up, and they'll give you the total current liabilities. Okay. Then we come to the capital structure, the capital base of the enterprise. So we have got the common stock, and we have got the preferred stock, different kinds of stock, equity that's held by the company. So we add up the common stock and the preferred stock, and we get the total capital stock, which is the capital structure of the organization. We also have, apart from the capital, the debt structure. We have borrowed money from other people like financial institutions. Okay, the debt structures. So there are secured loans and there are unsecured loans also. So we add up those loans, and what we get is the total debts. So we have got, I repeat, on the liability side, we have got the current liabilities, the total current liabilities, the total capital stock, the total debts, they are all there. And what are retained earnings?
Means the profits which we have earned.
The retained earnings, yeah. So the profits that you have earned as a result of your activities will be here. That is a part of the liability, mind you.
Means okay, won't that go under the reserves and surpluses of the company? Means the reserves and surplus column means of the balance sheet.
Yes.
We are supposed to put the retained earnings under the reserves and surplus column.
Yes, that is what we are calling retained earnings. We are given a different name here. Same thing. Okay. And as a result of this, the two things will match. The important thing is the balance sheet needs to match. The assets and the liabilities will have to balance, which is why the name is the balance sheet. So it is because of the retained earnings that your balance sheet is going to show the total amount of assets and total amount of liabilities as same. Okay. So this is something you have to prepare. You'll prepare it every year, okay, on a given date. But then you need to prepare it as of now as a pro forma and compare it year after year. Let's say what is going to be your balance sheet after the first year. What is it going to look like after the second year, after the third year, and so on. So we are again trying to project the assets and liabilities picture of the enterprise year after year, so we know what is the assets and liabilities situation in the company like as a result of the business that we carry out. Okay. So with this, I think we have come to the end of this particular episode. There are plenty of other things to discuss, like techniques of financial analysis, which we'll take up in another episode. But as of now, I think just to summarize, I would say that what we have discussed in this episode is this, that we look into three different aspects. One is the projected cost estimates for the project, the projected operating expenditure for the project, and the projected revenue streams for the project. And we try to channelize all this information into the pro forma profit and loss statement, into the pro forma balance sheet, and try to look beforehand into what is going to be the financial health of the entire venture, as of today, projecting it over as many years as possible over time so that the entrepreneur feels more confident about going ahead with that investment decision. Is this clear to all of you?
Yes, sir.
Okay, thank you very much.